stand by while NCLA cuts through the noise to signal abuse of administrative power. This is Administrative Static with Mark Chenoweth and John Vecchione.
I'm Mark Chenoweth. He's John Vecchione. That was John Mellencamp, and you're listening to Administrative Static. We wanted to talk a little bit, John, with the listeners about what's happening with these bank bailouts. We have the Silicon Valley Bank out in California, Signature Bank in New York, Credit Suisse in Switzerland. When the Swiss banks start to go down, John, I get concerned.
I get very nervous. Exactly. You always consider it's like Gringotts over there, right?
That's right. That's right. That's right. Yeah. So it's a little nerve wracking, but we've been sort of talking about this around the office, and one of the things that we've been trying to figure out as well, what's the administrative state angle here? Obviously you have the FDIC, that's the Federal Deposit Insurance Corporation, involved. And one of the things that happened in the Silicon Valley Bank situation, I think Signature Bank too, is that your deposits in these banks, and it's right there in the sticker on the teller window, John. And I don't know if it's there on the ATMs or not. I don't know, but I've seen it many, many times on the teller window at these banks where it says that deposits are only guaranteed up to. And it used to be a lower number, but it's FDIC insured up to $250,000.
I remember it was 50, and it went up to 250, and now with inflation, perhaps it should rise, but not as much as it rose last week.
Right, and if it's a savings and loan, there's the FSLIC that insures it up to a certain amount. But the whole point of the cap of the $250,000 is that it imposes some discipline on the banks and on the depositors, right? You have an incentive to keep an eye on the bank where you put your money. You don't just put it there and forget it, because if the bank because what does the bank do when you deposit the money there? I think people understand this. It loans that money out to other people.
George Bailey told them.
If it makes bad loans, then the money doesn't come back in, and the bank doesn't have money to give to you when you come to the bank to take out your deposits. That's why banks are supposed to make safe loans, and that's why there are capital requirements that they can't loan out 100% of the money that comes in. They have to keep some of it in safer instruments. And the irony of what was going on in Silicon Valley, John, is they were actually invested in pretty safe instruments for the most part. These were long-term government bonds, right? So it's some of the safest instruments. The problem is that they didn't pay any attention to the duration of these bonds. So they were buying these bonds that were many years out in the future, and they didn't have any of them coming due or coming mature. So when people were starting to take their money out, they couldn't cash in the bonds at par value. They could only sell them at a loss in order to get the money.
And let's just say this. So the reason bonds have a rate of interest, and the value of the bond goes down when inflation and interest rates go up, because people can get that kind of money elsewhere. So as inflation increased and the interest rates increased, the value of the bond dropped. So they had all these bonds that were paying them interest, that are very safe investments, but that could not be liquidated and capitalized without loss.
Right. They were worth less than they were when they bought them, or worth less than what they paid for them.
Right.
Which isn't the problem with a bond as long as you hold it to maturity.
Correct.
But because if you hold it to maturity, you get back what you put in, and then of course you get all the interest that you've been paid in the meantime. But they weren't making enough on the interest payments in order to cover the demands that depositors were making.
And then a rumor went around Silicon Valley. Of course, the owners of the banks, very incestuous. They're all out there swanning around in their yachts and their planes and all whatever else they have in there. And somebody decided that there was a problem, and so everyone rushed to get their money out. It was a classic sort of very I guess much upper income. It wasn't like everyone going down there so they could buy groceries. It was, and they all started taking.
But yeah, it was a bank run.
Tons, millions and millions, billions.
Right, and crazily, some companies like Roku reportedly had $500 million or some absurdly high amount of money just parked in an account at the bank, which isn't very good stewardship of financial resources for a mammoth.
No, you want the
mammoth
float
company.
somewhere. You want to get a float of interest on $3 billion.
Well, you want to float, you want to diversify
Right.
across different buckets. I mean, there's all sorts of things that a CFO would normally be doing with that kind of cash. But I'm not a CFO.
So then what did the government do?
So the government, so let me first say what the government could have done or might have done or should have done, which is the Federal Reserve is supposed to be the lender of last resort. And the Federal Reserve could have come in, looked at the books at Silicon Valley Bank and said, well, you haven't made bad loans. You've just been dumb about your maturity dates. And what we're going to do is we're going to step in and we're going to stop the run on the bank by backstopping the demands for the deposits with the understanding that eventually you're going to be able to take back over. And in the meantime, you're going to be under supervision and you're going to be not able to, we're not going to trust you to make good risk judgments about maturity dates and so forth. That's what I thought that the Fed was supposed to do. And by the way, if they had done that, they wouldn't have even necessarily had to make a public announcement that they were doing it. They could have just stepped in and just like, this is what we do. And there would have been some discipline there on the bank, and other banks would have said, oh, we don't want the government coming in and taking over our bank because we want to be able to make our own decisions about loans. So, hey, let's clean up, guys. Let's look around here. Let's make sure that we're not doing some of these dumb things in terms of maturities as well. If the Fed had done that, I think it would have not only solved the Silicon Valley Bank problem, but it would have instilled discipline in lots of other banks to say, okay, well, the Fed is there as a sort of lender of last resort, but we don't want to have to take advantage of that because it's going to cost us lots of things, including. And by the way, one of the things that the Fed better be doing at Silicon Valley Bank is pulling back all of these bonuses that were apparently paid out to executives
the day it was shut down.
The day it was shut down, and that's
so. But the other thing what they actually did was they said that the $250,000 of deposits they insured, they were going to insure all the deposits, and that
right without a cap,
and they do this because they evidently thought that they would cause huge crash in the whole banking system if they didn't do that for this bank. But this bank is the 23rd largest bank. The 23rd.
16th, I heard.
So exactly. So at some point, if you don't let anyone fail, what you do is that you privatize profit and you socialize risk, which means you get a lot more risk. And here, the one thing you said that
can you say that again? You get a lot more risk.
Why? You get a lot more risk because if you invest and the money comes back, 20% a year, you get all that 20%. But when whatever scheme it is finally collapses and you're losing, the government comes in and pays you anyway and takes the loss. Right. And so, of course, you're always going to do that. The only thing that disciplines you is the threat of loss. And so it is bad. And here, there's one of the administrative law angles of this, I think, is that because the Federal Reserve, they vote in a supermajority for these ideas. So the Federal Reserve voted by a supermajority to do this with the Silicon Valley Bank, but they're not going to do it for every bank, as one congressman pointed out in Oklahoma, you think they're going to do it for the oil and gas bank? That's not happening. And so it really is
clear favoritism.
It's both favoritism and it's unfairness. And we have rules, and there's a lot of them in banking. And the 250 is so that you don't lose everything, and that everybody in the world. But if anyone with more than 250 in the bank is a high roller, and so what you're really doing is you're using the money from everybody who deposits to back up people who had the ability to have investments in any bank they wanted.
Yeah, one thing I would think, just from a public policy standpoint, John, is maybe they can do some sort of assessment in the future only against accounts that have more than $250,000 in them or something like that.
Yeah.
Because otherwise, they said taxpayers aren't going to pay for this. Well, I got to call bullshit on that, because you may not be paying for it as a taxpayer with some sort of tax assessment, but everyone who uses a bank is going to have their bank fees go up as a result of this, because the FDIC is using money that had been saved up to solve problems like this, and it's going to have to recoup that money somehow. It's going to be through bank fees, and that's going to get passed down to normal depositors.
Right. And so that this is why in administrative law or any law, whatever the rules are, you should follow them until they're changed. This ad hoc, this is not, this was something where one bank failing might have saved a lot of things. Although there's one thing about this that's interesting, is that they bought about 3 years ago, when inflation was negligible, 1% or and had been for years, for almost 15 years. It probably looked real like genius, right? So the new inflationary period we're living through is going to change people who've never seen it. Certainly young investors, they've never seen it before.
Right.
So people always
think, it's not exotic.
I know, but people always think that whatever's happening is going to continue happening. And that's not true.
That's right. And the other thing, the bank didn't have a risk manager for months, like the last 9 months before this happened, apparently didn't have a risk manager. Gee, maybe you should have your risk manager at a bank who could be paying attention to things like this. But I'm concerned, John, that the implicit backstop here for all banks in the U.S., I've heard estimates between 17 and 19 trillion dollars. The Fed's bank sheet isn't that big. It doesn't have enough money to backstop all the banks in America.
Nope.
And yet implicitly it has suggested by doing it for these two banks that it would do it for all the banks. It can't, it won't. So what's the new rule? No one really knows. And that's, as you say, if you want to live in a world with the rule of law, which I think we all do, and not a rule of, hey, it's just up to Yellen and Powell to decide what they're going to do. That's not the rule of law. That's the rule of men. And that's not a place that we want to be, because you're going to get all sorts of arbitrariness out of that and lack of liberty. So we'll keep talking about this issue, but we just wanted to sort of whatever what's going on. You're listening to Administrative Static with Mark Chenoweth and John Vecchione, and we are joined by our New Civil Liberties Alliance colleague, litigation counsel, Kara Rollins. Kara, welcome to Administrative Static.
Thank you for having me.
So we've been wanting to talk with you for a while about a comment that you filed with the United States Sentencing Commission, but we've been winning so much that we've had to have these other segments that have jumped in. But earlier this month, you filed a comment on some of the proposed amendments to the U.S. sentencing guidelines. And there's a particular issue that you've been all over for the last couple of years, at least. And we've talked about it on this program a little bit, and that's Stinson deference. But and just to remind our audience, this is deference that the Supreme Court has said that sentencing judges have to pay to the commentary of the U.S. sentencing guidelines. And our objection has been that the commentary of the sentencing guidelines isn't blessed by anybody other than the commissioners themselves, whereas the sentencing guidelines actually go before Congress for an up or down vote. So we think that the judges shouldn't be paying attention to the commentary, or certainly not treat it as though it's binding. So how does that play into the comments that you filed, and what's the issue that you're trying to get the commission to solve or address?
Yeah, so stepping back just a little bit, because I think the Sentencing Commission is somewhat of a unique agency amongst other agencies. It was specifically set up by Congress back in 1984 by the Sentencing Reform Act, and it is a semi-independent agency within the judicial branch that is charged with, like you said, developing the sentencing guidelines. They've also, I think in relation to that, they do a lot of work regarding statistical analysis on recidivism, and they do a lot of good research in that area as part of informing their mission. And the reason the Sentencing Reform Act came into being back in 84 is there was just wild disparities in sentencing, and not just the typical, what maybe some folks would think would be like a regional disparity. What amount of sentencing you got was judge specific.
Right.
And so you could have people with identical crimes in the same courthouse going before different judges and getting really disparate sort of outcomes. And,
you get a loosey-goosey judge, or you get a hanging judge. And...
Yeah, you get a judge who's having a bad day and got stuck in traffic. There's all these little sort of nuances that could lead to disparities, which obviously create due process violations. Inconsistent sentencing makes it hard for defendants to actually defend themselves if you don't really know what's on the table, how much you're willing to lay in, or maybe even the sort of pleas you would be willing to take can vary greatly. So Congress set up this system, and they said, there's 7 members, 6-year terms, 3 Republicans, 3 must be federal judges, and only 4 can be from the same party. And it's, rotating. It's had a bunch of vacancies. So since at least, 2014 to 2022, to be exact.
I was going to say, since at least NCLA has been around.
Well, yeah. And I think that, one of the reasons this became a little bit more obvious is that even though the vacancy issue, and by vacancy, I mean just not having enough voting members at one time to constitute a quorum in order to take a vote.
Right. So the agency can't promulgate any new guidelines or rules or anything.
Guidelines. And all of this is very specifically laid out in the statute about how they do this. They have to do a notice of proposed rulemaking. They then come back after they get initial comments. They come out with the, proposed rulemaking. And then I believe it's by early May of every year is when they have to present it to Congress for voting. And that's for, as you said, that's for the guidelines themselves. Now, attached to the guidelines, and for all the attorneys out there, anybody's ever looked at, the rules of civil procedure, there's always commentaries, there's always notes after.
Why we did this, sort of.
Yeah, why we did this. Give us our additional thought and color. And so what the courts have said over time as that's been challenged is, well, yes, they can look at it, and then they develop Stinson deference, right? It's this idea that there's deference to the commentary because the commission is specialized in its knowledge and how this is done, how it wants to be done. As you said, the problem is one of these, meaning the guidelines, is actually gets an up-down vote by Congress, and the commentary doesn't.
And what I didn't say is that the sentencing guidelines range, that the commentary might increase the sentencing guidelines range approved by Congress by many months without clear statutory authority for that. That's where the real crux of the due process problem is for someone who's being sentenced.
For sure. And, there's certain, I can give an example of a guideline. There's fights over 2 guidelines that this happens commonly, but the one that I think is particularly interesting because it's easy, I think, for folks to understand is that there's certain types of financial crimes. Let's say you steal gift cards. This is the general scenario. Instead of looking at the actual value that's on the gift card, there's an assumption in the commentary that it is a $500 value every time. So let's say the gift card's $30, it's a $500 value. You get charged on the $500 value, not the $30.
Which makes it a felony.
Which makes it a felony.
At least in some jurisdictions.
And if you have 50 of them, you can see how that number increases exponentially. That increases your rating. That means that you spend more time in jail. So that's just an easy sort of explanation of one of the ones that's been tricky over time of how courts look at this. What happened in 2019 is the Kaiser decision, which we've talked about. And what it said is, you got to make sure that if you're going to move on to this deference analysis, that the statute or the regulation is truly ambiguous. And so here would be, is the guideline itself truly ambiguous? And folks have looked at this issue across the circuits on 2 particular, sort of, I would say, subsets to one guideline, and it's the career criminal offender guideline. And it's particularly crime of violence has caused issues, and what is a substance-based offense. What the commentary has said is attempt crimes we call inchoate crimes. So attempted, intent to sell, but not actually selling, say, controlled substances. Does that count for the career criminal offender sort of pattern growth? And the courts have been split. Now, post-Kaiser, what they've said is, well, let's go back and look at the guideline itself. Is the guideline ambiguous? And if it's not ambiguous, if it is ambiguous, what do we have to do? We have to pull out all the tools of statutory construction. And what you've seen is a circuit split develop. So what the sentencing guidelines amendments right now are trying to do is resolve that split, both as to the controlled substances aspect and as to the career criminal offender. So we submitted comments laying out the Stinson problem and saying, to the extent that, yes, this fixes it because it now means Congress has determined that this is okay, that this sort of upward departure in sentencing is fine, then that gets rid of the due process problem that's developed under Stinson, right, where Congress didn't approve it. But there's this other issue that we raised, and much like the $500 gift card rule interpretation, is that there's other parts of the sentencing guidelines that are not subject to amendment right now that include required language in the commentary, the maybe, shall. That type of language, as Judge Joan Larson in the Sixth Circuit has indicated, indicates a policy choice. And those policy choices are for Congress to make. So our point is that the Stinson problem is going to continue. It's not just about these little portions.
Right. It could crop up in other areas.
Crop up in other things. So the Sentencing Commission, now that there's a full quorum, should really do a holistic look at the code or the commentary and see where else it is cropping up. Whether or not cases have already cropped up, they shouldn't wait for a circuit split, right? Because there's people who are getting upward departures in sentencing as a result of this now. That's a due process.
And it could last
years of their lives.
In years of their lives.
And it could last for years before a circuit
split even develops, right? Yeah. Because especially if, let's say, it's commentary on a somewhat nuanced or rarely used provision, you could have one individual that it affects who gets a ton of time added to their sentence, and then it never raises again. So the Sentencing Commission, in terms, what we say is if you're looking for actual uniformity in what you're doing, you should be going out and affirmatively looking for these languages where you are doing a policy choice and put that to the vote of Congress.
And so that's what your comment has asked the Sentencing Commission to do. Why should the Sentencing Commission be the one to solve this and not the Supreme Court? Usually if there's an existing split, like you say there is here with these two things, we would think the Supreme Court would step in and solve it. And yet these splits have been there a while and the Supreme Court hasn't done anything about it.
Well, and this is something that Justices Sotomayor, Barrett, and Gorsuch have all written on, and in both of these provisions. And what they said in several of their statements respecting denial of challenges, specifically on the Stinson Deference question, they said it is the role of the Sentencing Commission, right? That is the job that Congress has specifically provided it to address these divisions and ensure, as Justice Sotomayor, to ensure fair and uniform application of the guidelines, right? And so I think the court has the view that this particular entity has been developed for this particular purpose. They actually have a pretty good skill set here, right? It's made of a mixture of judges and other appointees, and they should be the ones that should be taking the first crack at it. And I think that people respect that, especially now that there is a full voting quorum, but I do think there was a lot of frustration in the defense bar prior to this because the court could have answered that question.
Especially when there wasn't a quorum.
But I do think it also, in that instance, implicates sort of the bigger challenges to deference that we talk about all the time that sometimes the court just isn't ready to take. And so pushing it back on the Sentencing Commission is sort of the easiest path. But I do think from a policy perspective and getting Congress involved in the process, it's probably the most workable.
It does remind me of the ones the Supreme Court likes to take because they love the statute so much might be affected is the what constitutes crime with a firearm.
Right. Yeah, they might get to that. Well, Kara, thank you for filing these comments and for bringing the listeners up to speed. I don't know whether you've voted yet in the King George III bracket, but I do know that the U.S. Sentencing Commission, at least I think it's one of the 32 folks that can be voted for in the bracket. So if what Kara has been talking about makes you as mad as it does me, you may want to cast your vote for the U.S. Sentencing Commission. They're the one set of folks on the bracket that I'm quite confident are responsible for keeping people in prison years past when Congress has said those people should be in prison. So that's a pretty bad violation of civil liberties. But as Clegg Ivey told us last week, there are 32 nominees, and we'll soon be moving down to the sour 16. So if you want to have your voice count in terms of what jumps from 32 to 16, go to nclalegal.org and vote in the King George contest, or go to our Twitter at NCLA Legal and vote there as well. Kara Rollins, thank you for being on the program. You can listen to the chat.